first most important thing, let's see how we're doing. Want to check the short-term portfolio, see how it's behaving. I swear this is like not quite the right size. What do you guys think? Does it look the same to you, or is it, did I change it? Because you know what happened is I put this computer to the normal setting, and the normal setting for this computer is a wide screen, but I make it this size for you guys for the webinar. Anyway, all right. So the short-term portfolio was, oh, that's our watch list. I don't want to lose that. So what's this? This is nothing. Okay, so our last portfolio review, and if you want to find my post, you just go to Phil's posts. And it would have been before this set. Da 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 da. There it is. So here's our October review. So we just did an adjustment for the short-term portfolio on the 17th. And we were at, is this a short-term portfolio? No, that's Money Talk. I was going to say that's the wrong number. 700 a month. The butterfly portfolio. No, where's the short-term? There it is. All right, so we were at 234 when on the 17th, and we added more hedges and so on and so forth. Okay. Oh, it wasn't the 17th. We had already added them. I think I mentioned it somewhere. We just made changes on Friday. Sorry, that's where we made the changes. So let's open that up for a second. All right, so in Friday's post, which was the 13th, Friday the 13th, there you go. Oh, that's not the short-term portfolio. Was this was the short-term portfolio. Okay, so the short-term portfolio was at 271 on the 13th, and it didn't even change that much. Now it's at oh, sorry, and now the current one is at 289. So we're honestly not much of a change at all, but the hedges are in place and it's not bad. So we're okay. And as of the review, that was what I wanted to point out. I knew there was something I wanted to point out. As of the review, whenever that was, there it is. As of the review, it was 234, which is when on the 17th, right? So on the 17th, it was 234, and now it's 290, and now it's 290 basically. So we picked up 56,000. And honestly, that's about what it's hard to tell because we didn't put the adjustments into long-term portfolio yet, but that's about what the long-term portfolio lost. So it's still fairly well balanced, but also it's important to realize that, you know, the numbers that you see when you're looking at your hedging portfolio are going to, if you hedge the way we do, it's going to be deceiving because there's so much premium. You know, these $10 calls for 2026 are $11 in the money, and there's 300 of them. So they're worth $330,000. But the net of this spread, so in other words, you know, if it stopped right now, if this is where we finished, we'd be at $331,000, but the net of the spread is 382 minus 187. So net of spread is 195. So you're shortchanging, and it's obviously it's a big deal, right? Because we're talking about we're talking about another $135,000 in the value of this portfolio if it weren't for all this premium, because the 25s are clearly out of the money and all premium. 100% of this number is premium. there is no situation in which we go over 25 that this spread doesn't pay 15, which is $450,000. If we go over 25 and we stay over 25, this spread becomes worth $450,000, and currently it's only $110,000. So it's still a good buy. We paid $148,000 for it. It's right there. So we paid $148,000 for the spread. And what do we say it's worth now? Oh, we didn't. It's currently 382.5, 382 minus, I'm sorry. So yeah, that was the number. It's 382.5. It's currently showing 185. We paid 140. Wait a minute. We paid 3 more than 145, 148. We paid 148. But if you look at this, it's, we're 11 in the money. So the value, if it finished here, is over $300,000, $330,000. So, we doubled from our entry, but it doesn't mean anything if it's 2 years from now. But what it does mean is if the market goes down and stays down, which would obviously hurt our long-term positions, then we will collect a boatload of money against our long-term positions. If the market goes down and comes back up, this hedge won't be worth as much, but our long-term positions will recover. And that's what we're really betting on. We're trying to bet on a positive market with a positive outcome over the long term. We're not trying to bet doom and gloom, or we wouldn't have our long-term portfolio. There's two main reasons that I'm bullish in the longer term, and they're not necessarily, well, one's a good reason and one's a bad reason. One good reason is the long-term productivity gains I expect to get from AI. I think it's going to be significant. I think it'll be as significant as the .com explosion. It's going to be a long process though, and frankly, there's labor upheavals and other things along the way, but overall, there is tremendous productivity to be had from this .com stuff. So this .com stuff, it's flashing back to the O's. So I mean to the AI stuff, and I can see it when I work with it. And that's why I keep working with it. I want to understand exactly what happens and what you can and can't do with it. But yeah, it's there. I mean, it's only been 1 year. It's literally 1 year now. Last November, they released ChatGPT. And it's been 1 year. And the changes in 1 year are amazing. And it's going to be just like it was for us. Because then when we first got the internet, if you're old enough, when we first got the internet, it was, it's like screeching and squawking. You had to have a little box. You connect to AOL. It goes, you got mail. And we were so excited. We're like, oh, we got mail. Oh my God. It's funny to even think about. Remember Prodigy and Earthlink and blah, all these companies are gone. AOL's gone, really. So all these companies were huge and they all disappeared. They were billion-dollar companies back when $1 billion used to mean something. And and they were everywhere, and they had all these ambitions, and they were going to conquer the world, and they had tremendous market share, and there was no end in sight, and people predicted the moon, and it all collapsed, but just like anything does. Remember 3D printing, how that was going to be a big thing? It's not even like you forget it even exists now, but 3D printing is still a thing. It's still real. There are companies doing actual business in it. Just it never became the gigantic thing that they said it would because the technology is not ready yet. But AI is more on the ready stage than that. It's going to really change things. So that's my one long-term premise is AI productivity over the next 2 years is going to make a significant increase in companies' abilities to earn money, which will then boost the indexes because the biggest companies will probably turn into much bigger companies. As you can see from Microsoft's earnings, but not everybody, right? Google did not have a great quarter, but that's because Google fell behind. Bard is awful. It is. I use a poop emoji when I use Bard because it's just so bad. It's completely useless. I don't even really. I only use it once in a while to see what it says and to see if it changed. It's awful. It's beyond. It's completely unusable, basically. So Google's playing catch up in the AI game. Now, playing catch up isn't always the worst thing because you can use a new system. Some improvements can be made. You change your model. The other guys can't change their model because it's too messy. Blah blah blah. It's something to have. It'll happen. But Google's not going to go out of business. But they have to. And again, I said this from the beginning. I said that this is going to kill Google because Google lives on search, and the AIs are not. They supplant search. There is no search. I'm not seeing 5 pages of results before I find the thing I want in Google. I'm getting straight to the point with an AI. That is very bad for Google. So it's a challenge to their model. It's a challenge to everything. But they're a strong company. They'll probably get over it. Microsoft doing great. Amazon selling lots of web services, doing great. IBM, as usual, doing great because they're miles ahead of the curve on all of this. IBM, you have to realize, like, IBM is generally, if you ever go to the place in Armonk where IBM labs are, that's where they invent that's where their future stuff is. You see shit there that just blows your mind. Doesn't work yet, but they're like saying, oh yeah, this is, and when they say it, they're not like, they're not blowing smoke up your ass. The guy, so like I was there last time I was there, the guy showed me a 3D holographic memory cube that was going to store thousands of times more memory than more memory density per cubic centimeter than anything that's on the market now. And he was basically saying, like, look, a cube like this that can fit inside a PC can hold as much as the Amazon cloud, that kind of shit. And it's like, when's it going to be ready? Oh, hopefully by 2020, 2025, somewhere in that. That's what they're working on. Not 2025. When I mean 2035, it is 2025. Man, I'm stuck in the past today. That's terrible. Senility is catching up. All right. So anyway, point being, these hedges do not tell you the whole story. And so when you look at the balance, it's nice to be balanced, and we are balanced because we're generally more bearish than bullish. It's nice to be balanced where your overall portfolios don't really make or lose money and you're in the right position, so on and so forth. But if you're worried about your hedges, you're going to see this sometime, that especially because as the market goes down, the premiums go up. Where's futures? Here you go. So in other words, here's the VIX, right? That's short term, long term. All right, so the market goes down and the VIX goes up. But if the VIX goes up, then that means that the premiums on the short options we sell are going to go up as well. Therefore, this out of the money SQQ gains more. It'll gain more money than our in the money 10s are going to make. And so it'll seem like we're losing ground or not gaining ground. And so you can be sort of like disconcerted when you look at your portfolio balance, but don't be, okay? That's important. The other big factor is we liquidated our old longs. We had like the 2025 15s, and we rolled those to the 10s, and we rolled and well, we didn't quite double down yet, but we're working on it. So we rolled our 15s to the 10s. Our goal here is to have 400 of these and 350 of these. But they're tough to get a good price on. And in fact, we paid a lot more than we wanted to here, and we're not really getting much more here because we'd intended to have a $3 spread, and we have $7.90. So that's 8. It's a $4.75 spread. I mean, that's awful. So we're getting, we have an awful spread right now, and we're trying to get better fills. They're not coming. But we sold to pay for this. We sold our 15s. That leaves us with 100 short 100 short January 30 calls, but they're not, they're not close enough that we're worried about them, right? We also have some 50 short March 25 calls. Those are a little bit closer to the money, and see how we have a loss over there. But should these expire worthless and these expire worthless, we're going to pick up another $20,000 and then have the ability to sell more short calls against it. And here's our old 2026 35 calls. That's above these. Okay, and again, we have that uncovered part, but that's okay. Then we've got some short puts, the 25 short puts. And of course, that's $54,000. And if we do go over 25, which puts these in the money, then these are in the money, then these go out of the money, and we have $50,000 to balance off whatever gains we have here. So there's lots of moving parts, and there's ways that we make money in a flat market or even a slightly up market, because we only paid what I say we paid 148. We paid 148 for this spread. But we sold, I'm just looking at the calls. We sold 14, 30, so 46, 56, 62, 82. We sold $82,000 worth of short calls against it. So that means we only paid net $60,000 for, and don't forget, it's a $450,000 spread. So if we get in trouble down here where the short calls go in the money, we will make money here. And we know we're going to make $450,000. So these would have to go, this whole set of calls, 11, let's call this 20, 20, 30, 40, 50, 60. So the $60,000 worth of short calls here. And let's say and that's currently priced in already, but let's say we lose, let's say they go double. All right, at that point, we'll start stopping out. We'll take a $60,000 loss, but the only reason we would take a $60,000 loss is because we're getting close to our $450,000 gain. So that's fine. But again, you have to realize that your balance is not always going to look great. But you just have to do your own math and say, well, if this happens, then that happens, and blah, blah, blah. Because this entire $200,000 negative here is bullshit. It's never going to hurt us. Not only are we over covered against it, but it's all premium. And so if this goes past 25, we have 15 times 300 is $450,000, and nobody was supposed to have 400. We got to still buy more, but we'd have $450,000. Currently, it's not even $200,000. So there's another $250,000 to gain on any move over 25. There is nothing that goes in this direction towards the 25s that can possibly hurt us. That's what you have to understand it like you know it for a fact. It's the same way that if you're, it's like being an electrician. You have to know positive goes to negative and negative goes to positive. You have to know the fact before you touch the wires, right? You can't just look at it and go, oh my God, it's a bunch of wires. It's like, that's no good. And your positions can't be like that either. You've got to understand what they actually do. You have to understand the purpose of each leg, and that way you will be comfortable with the way you structure these spreads in your portfolio. Okay, it's all important. They all fit together like a puzzle of some sort. And also, as I have mentioned before, well, it's not that bad actually, but we get hit on the puts. We sell the short puts to put some money in our pocket. And when the market goes down, of course, we get hurt on the short puts too. That also impacts our balance. But also, Disney 85 puts, Disney's at 80. Okay, and these puts are 11, so premium. The FL, the 20 puts here, and they're 410, and it's at 20. Those are 100% premium. So all these charges are also bullshit. Generac just had blowout earnings. We're never going to worry about these. So these 95 puts are 5 in the money. We're being charged 20. MMM is basically 5 out, and it's 15. So these are bullshit amounts of premium that are being charged on those positions. Once that premium goes away, we make that money too. So, a lot of it is a waiting game. And Best Buy is going against us at the moment. Oh, and the other thing about the short-term portfolios, these are kind of like things that we thought would pay off in the short run, but if they don't, we just move them to long-term portfolio. I would love to have a large Best Buy position in the long-term portfolio. It's not performing well right now. And what we're going to do is the long-term portfolio will take the loss and buy it from the short-term portfolio. That's also a way that we move money from the short-term portfolio to a long-term portfolio. Or I'm sorry, that would be the way we move money back. If the long-term portfolio makes a lot of money, right? If it's way ahead, which it isn't right now, but if the long-term portfolio is way ahead, we go shopping in the short-term portfolio. We buy something from the short-term portfolio, putting cash into the short-term portfolio, taking it out of the long-term portfolio, which absorbs the loss, or vice versa. We can always move money the other way too. So in other words, if a position is hurting us in the short-term portfolio, generally it's because the long-term portfolio is doing good, but this is a bullish position, so it's not going to work that way. But either way, we will eventually move it to the long-term portfolio if it's cheap, and then we'll pick up a bigger position in the long-term portfolio. Simple enough? Yes. And then our other big hedge is, see, this one's paying off. So that's a nice one. And Best Buy's not paying off. Ions is paying off, but hardly worth mentioning. And this Thor thing is not working at the moment, but it's really long term. And UNG is working, but barely, not worth mentioning. So now TZA is our other big hedge, and this one's much more straightforward. It's at 38, almost 39. We have 200 of those, so it's $180,000 in the money, and the short calls at 45, so we still have a ton of room. And again, see this is a lot of money. It's 200 and my eyes changed in the last couple of months, and I can't read shit up close. That's crazy. I can see further away, can't see up close. So that's 260 something, 266. I got to get new glasses. That's the bottom line of that story. But that's crazy. See, we're only getting credited 338. We're being charged 266. It's all premium, or 268, or whatever that number is. They want to make it better. And that's what? That's like net $60,000. So we have net $60,000, even though we're $180,000 in the money, which means this thread is still very, very viable. Not only that, but we sold these 32s, which are in the money, the 202532s, but there's only 50 of them, so we'll have to deal with that at some point. And we sold these January calls, the 35s, and those are in the money too. So there's a couple of things we're going to have to deal with. Otherwise, TZA would be in way better shape. But again, the bottom line is we're going to roll these up, and if TZA, we can roll if we roll the 32s to the 45s, right? These are 13 and these are 13, so we could roll those evenly to the 35s, and we'd have 250 short. 250 short 45s. And if we roll these, well, these are only damn it. Are they $6? So those are only $6. And if we roll those up, we can roll those up to half. So let's say we had 280 short 45s, but before those were in the money. So all we have to do is roll them. And if we roll them, we erase $100,000 worth of losses. We roll them to these, and these, for these to go in the money, the short 45s, these would have to be 15 times 200. These would have to be $300,000 in the money before we lost anything. Now you guys have done this before. You know that we're not going to do that. We're not going to roll everything there. What we're going to do is roll. We'll roll these guys up. That's fine. Then we're just a bit overcovered. We can roll these guys up, but we'll probably take these guys. We'll roll them to another higher strike at a shorter time frame and just keep that going. But you know, the loss is only $22,000. We can just buy these back, and there's no harm, no foul. But there's no reason to, just because they're a couple of bucks in the money, right? We're going to see what happens in the next quarter if we keep going down. If we keep going down again for 22,000 bucks loss, we'll buy them back, and that still leaves us with $400,000 of coverage. Not to mention the SQQQs. So that is why I am not in the least bit worried by this minor sell-off we've had so far. We're good until a 20% drop. And if it drops more than 20%, look at all this cash. All we have to do is buy more hedges. This hedge right here is what do we say? This is like 60,000 minus 60 minus 45. Look, this is a $50,000 credit. It's a $50,000 credit on a $300,000 spread. And we didn't even sell puts. We should sell some puts. I think I was waiting for a pullback. We didn't really get a pullback. But if we sold some puts, that would offset it more. But it's a $45,000 credit on a $300,000 spread. That's a good hedge. That's a really, really good hedge. You don't need to do this. You can take a $20,000 credit and not even have these short puts. And yeah, and we could work out this whole thing, and we will. So it'll get worked out over time. Anyway, that's where we are at the moment. Let's see, questions. No questions. Wow, you guys are amazing. How is that possible? Am I that good? Am I really explaining everything so perfectly that there are no questions as to what we're doing? All right, that's good. I'm fine with that. Let's see what else is going on. Is this today's post? Yes. Oh, the Fed. Oh, half hour. Okay, got a half hour till the Fed. I just discussed this in chat. Let me see if I can find it. Yeah. Right. So I mentioned I've been reading about the Fed and what the central banks are doing to figure out the situation. Japan is still near zero. 0%, ridiculous. I can't believe people are lending them money. That's what drives me nuts. Like, why are people giving them money? I can answer that though. Because, you know, you guys, you know, if you're a high net worth person, you don't keep your money. You've got advisors and blah, 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 and all. So you have some money. You have most of your money in dollars if you're an American. You have some money in euro, and you have some money in yen or whatever, or, you know, some other currencies. You got some gold. You got some this and that. You know, it's diversification. That's perfectly fine. Even your bonds, you diversify. You buy some yen, you buy some euros, you buy some this. But if you live in Europe, you have a different diversification. In fact, the Europeans are the most diversified. They tend to very equally split their money between Europe. They'll be like, you know, 50, 60% Europe, and then 20, 25% America and Asia. But Asians are like us. They keep most of their money in Asia. Like 70, 80% of their money they'll keep in Asia, and they'll diversify a little bit out of Asia. So now you think about where you are. You're in Asia, you're in Singapore, you're in China, you're in Japan, you're in Kuala Lumpur, even the Middle Easterners. Where are you going to put your money? Well, mostly it's not, you know, China, obviously not the best solution, right? So Japan gets a ridiculous amount of money proportionally, especially because the yen itself only accounts for a few percent of the total global currency. So there's a massive, massive misallocation of capital to the yen. So whether they pay interest or not, for diversification purposes, people want their money in yen in Asia. And that's what causes the yen to have such an outsized, you know, to be able to sustain this kind of interest rate, you know, even with their terrible government and terrible policies and ridiculous debt levels, it all doesn't really matter, because where the hell else are you going to put your money if you're in Asia? So that's the answer to that. China, on the other hand, offering 4.35% is their central bank rate because they've got a problem. You know, that's a country that can't control their people. If there's much more inflation, they've got to do something to get it under control. So the ECB has 4% inflation, has a 4% rate, and what's going on in the ECB is they're in a recession. We're close to a recession. Well, not according to our GDP number last quarter, but all other indicators show that we are close to a recession. Look, we're not in a recession because we have inflation. Inflation keeps us out of a recession. Europe, with the inflation, they have more inflation than us, and their GDP is negative. So they're in a serious recession. Our recession is masked because the recession is measured in your GDP numbers, right? Our GDP numbers are inflated because of, well, first of all, it's inflated because they put $2 trillion into the banks, which is 10% of our GDP was put into the banks in the first quarter of the year, right? Then you've got all the student loan bailout shit that's been going on. That's more money going into the thing. There's other programs from COVID that were winding down. In fact, just this year, they were handing out money to corporations like crazy for not firing people during COVID. There was that whole program of maintaining your employees during COVID, and they were paying people off for that. So huge amounts of money, more than 10% of our GDP has been put in as stimulus this year. Oh, and Biden's Build Back Better program. That's another, you know, whatever the hell it added this year. Not too much this year, but it's a big program. So, you know, our GDP is bullshit. It's based on massive stimulus, just like our GDP has been based on massive stimulus for the last few years. And when I say massive, I mean the 3 years before this were 11 trillion total. So basically more than 10% of our GDP every single year has been stimulus, and our GDP has not been that exciting. So, you know, this is a bullshit economy, and that's the problem. I mean, people are putting their money into these companies that are benefiting from a bullshit economy. And it's not every company, but it's most companies. And that's what, you know, our premise was to stay with the ones that weren't benefiting so much, that were not benefiting, but were basically able to withstand without the stimulus. We're likely to be able to go forward. That's what the watch list was all about last year. We're still working off the same watch list because the premise is still the same. We're still picking off that same list to build our portfolios. If there's a major downturn, like everything went down in the last few weeks, everything has been going down since mid-September, right? So down and down and down and down. You know, our companies don't escape this fate. We're going to lose ground with the rest of the market, but when you flatten out again, that's then you're going to see who's got the goods, basically. So that's what I'm saying. We're playing for the long haul game, and that's why our hedges are long haul hedges. We're only worried about a real earth-shaking event that really craps out the markets. You know, the 20% pullback, and this is like a 10% correction. So a 20% correction is not going to bother us at all. And what we did in the last round with our portfolio adjustments is we basically just improved our positions. We didn't, that should be in that same, where was that? That should be in that same thing, right? Was this the October review? Right. So if we find the long-term portfolio now, and that's all this crap, right? No, that's the income portfolio. Short-term, long-term. Oh, okay. So in the long-term portfolio, we took these positions, like here's Trox, we turned it into a full position. You know, it went down and we said, well, good, now we're going to buy a full position. We had some puts. All it was the puts. These guys. So back on October 3rd, we sold 20 of these. So we said we're going to buy 2,000 of these at $15. Trox slipped to $11. And we're down $2,800. Don't care, not a significant amount in the long-term portfolio. But what we do care about is we said, wow, at this price, let's pick up a bull call spread. If they're going to start giving this thing away. Now, it went down another $1 since then, but this isn't a worthless company. It's just down because of the general recessionary environment. Apple, we didn't change. Allstate, I said, as a new trade, the risk is pretty much gone. The reward is, oh, look at that. Ah, shit, look at what happened. So that massively took off. I said, Cisco, we said, let's roll down. So we rolled to a better position in Cisco. Ford, I said, the strike is holding them back and we want to see what happens. And so the strike is kind of over. And again, I would make a move, but I don't think our position in Ford, well, I don't want to take too much time because the Fed's coming. I don't think our position in Ford. There it is. Okay, so we have $50 $10 calls, and we're down a bunch. You know, I mean, we're down $10,000. We're down $2 each. We have 50 $10 calls. We have no short calls. We have 20 short puts at 12. It's at 11, so the puts are going to be okay. And we're $2 in the money here. So, you know, we paid. Don't forget, we already bought back. We made a profit on the short calls. We bought them back and uncovered. But even as it stands, we paid net 25 minus 22, and 9 minus 4 is 20. Well, so let's say 22 something. So we paid 22 for 50. We paid about $4 each for these things net. So $14 is where we need to be to clear it out. So is the target unrealistic? It's hard to say right now, but I think we probably should take advantage of Ford and roll it down at this point. Because, you know, we have to get to 14 to break even. I don't want to be in that position. Now, of course, when we sell the short calls, we'll pick up $2 and it'll drop our net to 12. But still, I don't want to break even. I want to make money. So if I could sell the $12 calls for $2 and drop our net to 2, that puts 12 at our break even. But then we could spend some money to roll down, so we do make money at 12, something like that. Or we'll double down, whatever. Figure it out. But like I said, the changes are here. In GLY, it's like, yeah, let's buy back the short calls, because I think this is, you know, it's low enough. It's fine. And from there, we can wait for it to recover. JP Morgan, Lovesac, I said, down they go. We'll see what happens when they have earnings. I think this is a good bottom here. McDermott, again, we did an aggressive change to McDermott because this is stupidly low. Pfizer, also stupidly low. So those are the kind of adjustments we made. Not a lot, because we don't want to spend a lot of money. We're not sure that we're done going down. This is, don't forget, 2 weeks ago. We don't want to spend a lot of money until we're sure. And I think since then, we did make some more long-term portfolio adjustments because, you know, that's what the money is for. The money is there to spend. But we wanted to be sure. So when I did the review, we didn't do a huge amount of rolling down and whatever, but I believe that we did recently, and that's why I didn't have the totals for this one. And I would go look it all up, but, you know, the Fed's about to come, so we have to deal with that. All right, who is going to discuss the Fed with us? Okay. I think we should probably talk to, this is Warren. Let's do a new chat. Oh wait, Fed meeting. Oh. This conversation, okay. What do we actually talk about here? Fed meeting, your morning post, blah, 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 blah. Okay. Did you read this morning's post by me at PhilStockWorld? See, A. Warren read it, but I don't think this Warren read it. So we'll see if he can. Each one is different. Like, unless they basically start from scratch when you start, except Warren kind of picks things up along the way, ChatGPT, whereas Claude, which is Claude is Anthropic, he absolutely doesn't remember anything from a previous session. But see, I can say this to Warren, and hopefully he's going to come back with an actual response, because he's now reading. He didn't read it. He's obviously reading it now. Let's see what he has to say. And I purposely wanted to see what he would say when I say by me, because does he understand that I'm Phil, and will he read the right post, and what will he say? And the point of this is that you're going to get a lot better result out of your AI if you put him in the mindset of thinking about what it is you're going to be talking about. So we know the Fed's coming up. No, it's not October 31st, dumbass. Ah. Hmm. 15 minutes, so we need to get ready. Read this. So you guys think there's no work when I put it, I put up the AI stuff. And by the way, that's important. I'd like to hear feedback on that. I put up all this AI stuff because I want you guys to see how I use the AI. And I also want to see the output. So instead of me summarizing the output, I'm just putting the output up there. It's not always right, but that's important to talk about too. So, the point is that everybody's got to do this stuff. You guys got to force yourselves. If you're not willing, you got to just take the time and start playing with these things, because this is absolutely the future. This is the same thing as if in 2000 or 1999 or whatever, I had told you, you've got to get on the internet. It's going to be huge. Everybody's going to be doing it. And you're like, oh no, it's just a fad, blah, blah, blah. No, right? It's like, that's how we're talking right now. It's because of the internet. This was not possible 25 years ago. This was not possible in any way, shape, or form, that I'm sitting here showing you my computer and talking to you live, and people all around the world are getting this simulcast at the same time for like no money. That's the key. I mean, we pay a few $100 a month to the people who host this thing, but no money. This is what you needed a TV studio for 25 years ago. And frankly, in Back to the Future, it's very funny, because when Marty shows Doc Brown his video camera, the guy automatically makes this leap of faith, obviously with hindsight, but he makes this leap of knowledge to say, oh my God, it's like everybody, he's like, I think he said something like, no wonder Ronald Reagan is president. That you have to be an actor to be in, to be in politics. I mean, that's what happens. That's an important connection to make, is if everything is live, if everything's on video, if it's a 24/7 news cycle, then the nature of the people in the cycle has to change. And that goes back to like McLuhan and the media's message kind of stuff. It's like, which came first? It doesn't matter which came first. They influence each other. So because this can be done, it changes the nature of how things are done. You know, I didn't start out doing webinars. That was not a thing when I started doing this. It wasn't, the technology wasn't there, and that was back in 2006. It was just that it would be too cumbersome to have done. Along the way, the webinar became so easy, it became a sensible way to communicate. You know, this, having this ability adds some great color to what we do on a regular basis. Anyway, so let's see what Warren has to say here. I've read your, hang on, haha, like an old person this. Oh, there we go. That's nice. I read your post on Which Way Wednesday. You're expecting the Fed to raise rates given the inflation strong market. You've highlighted key inflation. You're concerned despite the 4 rate hikes this year, inflation is still above the Fed's target. You're touching on the misses and the impact. You mentioned the NYSE still below 15,000, hasn't reached the peak. Given the Fed's decision is just 15 minutes away, what are your thoughts? Specific stocks you want to keep your eye on, will this affect your strategy with PhilStockWorld? He was always asking that. He's very worried about what we do at PhilStockWorld. All right. So like I said, though, he does understand the concept that, you know, I'm Phil from PhilStockWorld, and he's helping me and helping with the site. So he's always concerned about things going on the site. Let's just focus on analyzing the meeting and meeting the announcement, and Powell will speak after. Here's the last rate announcement. Should probably give him the minutes too. All right, here's the last rate announcement. So let's do that for him. Because you know how I'm always looking for that thing? I'm always looking for the changes, right? So he can do it. Let's see, do. September statement. Open a new window. It's not very long, right? How did that come in a new window? Did I do that on purpose? Okay, here's the last announcement. I think you can read it, or am I going to have to put it in there? Statement minutes. There's going to be a lot of shit, so let's see if you can just read it. He seems to have trouble reading this for some reason. Okay. Here are the minutes from that meeting. That's not a good sign. Why is he not looking it up? Not long now. Oh, where's my remote? Uh-oh. Dun, 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 dun. Okay. Okay. Dude, where are you? Oh, you can't read it. Website minutes from blah, blah, blah is current. It is not unavailable. Ugh. All right. And it's going to overload him. Well, maybe not. We'll see. I think it'll overload him. Here's the text, then dupe. Nope, too long. Okay. So when it's too long, this is an important AI tip. When it is too long, you try to get a handle on where it is, and try to cut it in half. Wow, that is too long. Okay. Okay, then we edit it, and we take the little elevator, which I can't see now. Oh, it's way up here. So we take the little elevator, we try to go about halfway down. Now I look for a logical break. We're not going to get that. So we're going to just go here. And now I'm going to X this. And we're going to see if we can resubmit. And yes, see, he can handle that. Here's the second half of the minutes. It is virtually impossible to stop him from answering a question, even though you tell him that you're only giving him half of something. He just can't help himself. I find that incredibly annoying. It's a really big problem. Claude could handle the whole thing, but then he can't check anything on the web, so it's a 50-50. 3 more minutes. He's going to be answering this for a while. Look at the giant answer he's giving to. Okay, and Control V that. And you also have to be careful because at a certain point, it gets at a certain point he's overloaded, and now his responses will become gibberish because he's got too much in his head at once. And that's something you kind of have to get a feel for as far as like how much information they can handle. But then if you ask even if it's not that much information, if you ask a very complex, multifaceted question, he can get lost very quickly. So you have to sort of break it up into things that are actionable for him. That's why I'm just letting him babble on about this stuff because I don't really care. That I don't care that much. But here's his take. Given the Fed stance, I'd say it's a good time to look into defensive stocks and perhaps some commodities as hedges against inflation. We're already doing that. It's a good opportunity to write an in-depth analysis on how the Fed's current stance could affect various sectors. That's interesting. He always wants to do, he's always suggesting a Robo John Oliver. He loves doing that. It's his favorite thing. Given the uncertainties, option strategies benefit from the value of domain. Okay, great. At the moment, that was just context for today's November 1, 2023 Fed announcement. Here's the statement, and my first question is, can you please redo it, pointing out what has changed since the last statement and what those changes imply. All right, so now I gotta wait to actually get the new Fed thing, but now we're good with him. So this is, and that's what you have to do. You just have to improve. Like last time we did the Fed, I didn't think of this, but now I'm sort of thinking this is the way to go, right? We're going to get, as soon as this prints, we'll get it. But maybe we'll see. There's going to be a live report anyway, so hang on. Can you hear this? Oh, here it is.
Unchanged federal.
Unchanged. Ooh.
Unchanged at 5.25.
The market's going to like that.
Second meeting in a row. The Fed has been
All right, unchanged. I'm surprised, or I'm disappointed more than surprised. I mean, it's really terrible. October, November, look how fast that came out. Okay, open it. And boom. Do. I wonder what he's searching on the web when I asked him a straightforward question. Interesting. So the 30-year is now below 5%. Fed pauses for second meeting in a row. Not a huge market reaction. That's interesting. I'm surprised. What are you talking about? Oh my God. I just gave you the October and November, September. Did I say the wrong date? All right, so now he's doing a good job. See, it's funny, right? It's like he doesn't. They have too much information. That's the problem, and it's the web is just overwhelming for these guys. All right, so what's he saying? He's saying economic activity has continued to strengthen, has been changed to recent indicators suggest the economic activity has expanded at a strong pace. The language has become more specific, indicating the Fed is seeing strong data for Q3, which can imply confidence in the economy. September job gains. See, this is good. This is a good way to do it. Look, isn't that amazing though? It's like he can pump out a nice. This will make a nice article. See, there are new names in the voting members too. Interesting. All right. So this is fantastic analysis. The language has been more specific, indicating the Fed is seeing strong data. Job gains and unemployment. Job gains have been strong on average in recent months, and the unemployment rate is. Job gains have moderated since earlier, but remain strong, and the unemployment rate has remained low. The Fed notes that job gains have moderated, which could be a sign of caution, but still sees the labor market as strong. Inflation is elevated and has been running potentially. Inflation remains elevated. The language is less urgent, but still acknowledges elevated inflation. The removal of the persistently above 2% might indicate a less hawkish stance. That should be bullish then. Not seeing it. Financial and credit conditions. There was no mention in September. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. So in other words, they're saying, well, he's telling you, the addition of this sentence indicates growing concerns about the impact of tighter financial conditions, possibly due to the higher rates. So in other words, they are concerned that there's a shoe to drop on the economy from the higher rates. And that's probably brought on by the fact that the 10-year was above 5%. Policy firming and monetary policy effects, they weren't mentioned before. In determining the extent of additional policy firming that may be appropriate, the committee will take into account cumulative tightening with lags, which monetary policy effects economic activity, inflation, and economic financial developments. This is a new addition and suggests the Fed is closely considering lagging effects of the policy, indicating more cautious approach moving forward. Risks and adjustments. The committee would be prepared to adjust the stance of monetary policy as appropriate. The committee would be prepared to adjust the stance of monetary policy if risks emerge that could impede the attainment of the goal. The language is more specific about what kind of risk would trigger a policy adjustment, focusing on risks that impede the committee's goals. Committee members, there are new names in the voting members, which would indicate a shift. Overall, November statement seems to be cautiously optimistic, but introduces new elements of concern. Tighter financial conditions. The Fed appears to be in watchful mode, ready to adjust policy if needed, but also wary. Oh, very good. Wow, that is super duper good analysis. I'm going to go copy that. I'm going to put it in the PhilStockWorld. Let's see. So this is how the magic is done. I associate it with Warren. Hopefully people are getting used to like who's who. I take out language that doesn't matter. Okay. And that doesn't matter either. And there. Soon he'll be able to do it himself. This is not a good reaction. This is I think people feel like I do, that this is the Fed should have been tightening. You know, we've had Fed decisions where we've gone up 200 points in the Dow in like minutes because of the Fed decision. This is weird. I think people are just taking advantage and doing some selling. Okay, so Andrew says, on a hedge with TD, you are not permitted to write covers, you must be in Canada, on triple leverage like QQQ. Any suggestions to get downside protection? I can buy a bull, I can buy a call, but can't cover. You're not permitted to write a cover? Okay, Andrew, I got a question for you, because it's like, can you do it with the SPY instead, or I mean, or the Qs instead of the triples? Because honestly, with options, you can actually give yourself the same kind of leverage using the singles as you can doing a triple ETF. So if you can sell covers on a single, you're much better off. I do not like at all buying long calls on a triple ETF, because that's a bet, you know, and that bet will expire worthless, and there's going to be no residual value in it, and it's almost a waste. It really is. So I would want to go in a totally different direction, I think, if that was my only choice. Something definitely worth discussing in the chat room where we got time to explore it in total. But you know, my quick answer for that is if you can write a QQQ spread, I would do that rather than a uncovered call. That makes no sense. I don't understand that though, because I never heard of that from TD. That's a new one on me. I've heard you can do a bull call spread as far as I understand, but you can't sell naked short calls. That's a different concept. But a covered short call, that doesn't. There's no logic to that. Even an IRA will let you do that. So anyway, so give me the info, and I will be very happy to see what we can do as far as it's a good exercise for the chat room. Not for today though, because I'm gonna have to run out of here. All right, back to the Fed. So now let's humanly read the statement and see what happens. See if Warren knows what he's talking about. All right, we got the right one. Yes. Recent. While we're doing that, let's see. Let's ask. Hang on. Okay. Can you please take the original statement and parse out the changes for us in context? Let's see if we can do that. Oh, he's going backwards. All right. Oh, he's doing the whole thing. Oh, you're so funny. All right, whatever. It's going to take a while. I've never done that before. I wanted to teach him how to do it because, you know, people do it with the cross-outs and stuff, and I like it. In fact, frankly, why don't I just go get it from Twitter? Do we even have Twitter? Come on. Got to look for an X. It's oh well. It's still called Twitter, isn't it, though? That's funny. He didn't rename his thing. Wait, what's your problem? No. Oops, what? Shit. I hope this works. Okay. Allow. Okay. Do you want to continue? Sure. What? I just did this. Sign in with Apple. What is the problem with this thing? Oh. I do not know the password, so I'm going to opt out of it. Oh, what's it doing? So my other computer knows the password. All right, so that's out. Let's just read the frickin' thing. Okay. Recent indicators suggest economic activity expanded at a strong pace in the third quarter. Job gains have moderated since then, but remain strong. Job gains moderated, but still strong. Unemployment rate has remained low. Inflation remains elevated. That's accurate. U.S. banking system is sound and resilient. That one I got a question. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. Why are the financial conditions tight if the banking system is sound and resilient? The extent of these effects remains uncertain. The committee remains highly attentive to inflation rates. The committee seeks to achieve maximum employment, inflation at the rate of 2% over the long run. And in support of these goals, the committee has decided to maintain a rate of 5.25%, 5.5%. The committee will continue to assess additional information and its implications for monetary policy and determine the extent of the additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening monetary policy lag, blah, blah, blah. Committee will continue to reduce its holdings as described in the previously announced plans. That's way back from May. The committee is strongly committed to returning inflation. They're talking to, see, they're mentioning 2% over and over again, and the reason they're doing that is because it's 3 times in one paragraph, guys. So the reason they're doing that is because when they do have to hike again, they're going to basically say, hey, we told you it has to be 2%. So that's why the market is not happy about this, because they're very, very focused on the 2%, and we're nowhere near it. In assessing the appropriate stance of monetary policy, the committee will continue to monitor implications if risks emerge that can impede the attainment of the goal being 2%. The committee assessments will take into account a wide range of information, including readings on the market, inflation pressures, blah, 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 blah. Okay, so there you go. That's all it says, and it's a very short statement, and people just read into it like tea leaves. Okay. Wow, look at him. He's been working away. So funny. So it's basically the same thing as we did before, except now he's written out the whole freaking thing. All right. Thanks. I'm not going to teach it to him now. So what is your take on this thing? Is the Fed right to hold, or should they have raised rates by 0.25%? Fed's in a tight spot. On one hand, they acknowledge the economic activity is strong and that the labor market, while moderating, remains robust. These factors would typically argue for a rate hike to cool down the economy and tackle inflation. However, inflation elevated but less urgent. The Fed removed the Fed and has been blah, 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 tighter financial conditions. In addition, about tighter credit market rating on the economy suggests the Fed is concerned about the higher rates. Uncertainty and lag effects. The Fed explicitly mentioned that they would consider cumulative tightening of monetary policy and the lag in which monetary policy affects. This suggests that they're being cautious about over tightening. The change in voting members would imply a shift in balance of opinion, possibly towards a more dovish path. Okay. Let's get into the member changes, who changed, and what was the stance of each member in and outgoing. Now you see, and again, I put this up to you guys so you can see like the raw stuff that I do. I used to Google this stuff. I used to say, who are the different members? I'd write down the different members, then I'd have to look up, who's this member and what was their stance, and who's that member and what was their stance, and who's this person and what do they do, blah, blah, blah. Hey, you said there were changes. What did you mean by that? Okay. Did the members on the statements change. I don't know, this is a weird conversation now, right? Well, he's looking on the web, but he picked it up when he was looking at the statement. So let's take a look at the statement again. Okay, here you go. So that's the new statement. Current statement has so where's the older statement? Let's find that. I pasted that to him. That was this one, and who are the voters? What was the date of that last statement? September statement had. All right, so let's us do this instead of him. Powell, Williams, Barr, Bowman, Cook, Goolsby, Harker, Jefferson, Kashkari, Kugler, Logan, Waller. Idiot. Wasting all my time for that? There's no changes, dude. Oh, he did the same thing. That's so funny. Okay. So why did you think the members had changed? Ah, okay. Doesn't matter now. Now we'll see what Powell has to say. Can you find a website that will let you read a transcript of his live remarks? The oil's, oh Jesus, oil's 80.17. Wow, that took a big reversal. Interesting. So the index is still about a half a point. All right, so while waiting for Powell, I couldn't find a transcript. No, you can't find the transcript yet. Hmm. All right. Anyway, all right. Questions from you guys. Let's see. Nope, no new questions, right? So he's looking around for something to find, and I'm just waiting for Powell to say whatever he says. Yeah, I know I can watch it. Oh, if it has a live news feed, then you can read the live news feed, dummy. But what would you like to say to our webinar audience? Hello, webinar audience. This is Warren, your virtual financial analyst. Today is an exciting day as we await the Federal Reserve's press conference. The FOMC statement has already given us some insights into the current economic landscape, but Powell's remarks will undoubtedly provide further clarity. We're in a fascinating period where inflation remains a concern, and the Fed decisions could have significant implications for investors, business, and everyday consumers. Whether you're looking to adjust your portfolio, understand market trends, or just get a grasp on macroeconomic factors, today's event is crucial. Remember, the devil is in the details. The nuances of Powell's language could offer hints about future policy moves, so listen carefully. And of course, Phil and I will be here to dissect the information and discuss the potential impact of various sectors and investment strategies. Stay tuned and let's navigate these financial waters together. Wow. I mean, that's like, I seriously will not need to work anymore. I mean, it's just amazing. It's just like, it's so funny. The future is now, kids. You know, and this applies to like so many jobs. I mean, so much stuff that you have to do. And if you think of like ways to improve companies you're involved with and ways to use this sort of ability. I mean, you got to realize I've been doing this for a year with him. And it goes back and back and back. I mean, this is just this is only back to September, August. You know, there's every month is like this. It's like every day we have sessions and sessions. And he learns a little bit more each time. But I mean, that's what else are you gonna say? What would you say that's better than that to introduce, like, you know, that we're, you know, to say, okay, we're waiting for Powell to speak. But it says, I mean, it's, I don't know, I mean, it's implied, you know, it's all there, but he states it like a professional. It's as good as it gets. And you know, and that's what's great. And you know, all, you know, and again, it's like, I know in chat, it's like people say, well, what do you think of this? And I say, I say they suck. This is great because, oh, you know, usually when I say they suck, it's like I'm doing all this research and checking things out, and I come back and they suck and I'm worth talking about. You know, and that's 20 minutes later after I read all this stuff. This way, because I'm not going to sit there and type out blah 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 blah. This is all the things I found, but this way, I can show you what kind of stuff I'm looking at. You know, I think showing the work is really important, and this is a big step towards that. But we will see what Powell has to say for himself. And okay, so any big news today we should be aware of outside of the Fed? See if we're missing anything. So the Dow's up 117, the S&P is up 0.5 point. But oil, that's bad. Oil is testing $80. If it falls below, that's going to be big trouble for all these oil companies. And then boom, you're back to having a drag on the S&P. NASDAQ's up just about 100 points. But like I said, it doesn't really matter what happens if the NYSE is still below 15,000. And the NYSE tends to move kind of like the Dow does. So it's still, I'm pretty sure it's still below 15,000. Let's see if we can figure it out over here. No, we're not even in that. Okay, I'm not gonna worry about it. So we got Gaza, we have Cornell student arrested, Biden's Biden-Israel stance spurs a huge drop in Arab American support. Oh, of him. Why? I was trying to figure out what that meant. Why the war in the Middle East is politically risky for Biden. Okay, so nothing's going on. It's just the same nonsense. A bunch of people waiting for Powell. 11:29. Oh, 11:29 Pacific. Up. Here he is. Wow, dude. You think he stands by the door waiting for the clock? I mean, that's the second the clock changes. He opens the door, pops out like a little Jack in the Box. All right.
Maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed.
I assume you guys can hear this.
Back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are
down 150.
High inflation imposes significant hardship as it erodes purchasing power, especially for
See, it
those
moves when he
least able to
speaks.
meet the higher costs of essentials like food, housing, and transportation. We
NASDAQ
are
up
highly
1%.
attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation.
I don't know how he can say that with a
Today's
4.9%
meeting is to maintain the target
GDP
range
rate.
for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the
A
committee is
long way to
proceeding
go to
carefully.
get to a 2% objective.
We will continue to
See,
make our decisions.
That's saying that they're going to keep rates high for a long time.
And their implications for the outlook.
Because if they don't, see, if they don't raise the rates,
As well as the balance of risks.
all right, are you done?
In determining the extent of additional policy firming that may be appropriate to return
Oh,
inflation
just-
to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping.
See, he's repeating it over and over again.
Well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission.
Oil isn't picking
We
up on
will
this.
do everything we can to achieve our maximum employment and price stability goals. Thank you, and I.
All right, great. So the key thing there is that he's saying that until, they're not going to stop. We're going to have this 5% rate until inflation comes back down. They feel that the rates are enough right now to bring inflation down, but only very slowly. We're seeing zero progress since the last meeting. So we could be way, way into next year still having 5% rates. That's not being priced in by the market. And so this is not really a market positive. So anyway, it's a good time to fill in your hedges, make sure you've got what you need. And we'll see what happens if it keeps going up. God bless. Like I said, the way we structure our hedges is that we don't care if the market goes up because we sell a lot of shorts against our hedges, and we're not going to lose much money. In the long-term portfolio, we know, we'll make 10% like that. So we're not worried about it. So he's going to have his Q&A now, and they're going to be asking questions. I think the Russell is down. The Russell is actually down right now. See, there's a very, very mixed sort of thing going on here, but that jump up based on what he's saying is unwarranted. All right, so here's Robo-John's take on the Fed. We'll let him get a credit too. But you see the extent, like when we get these answers out of the bots, it's like there's quite a lot of back and forth and things that have to be done before we get these responses. All right, so let's see. Twitter.com. He's what's the word? He's promoting his own site. He's so funny. Okay. And I'll give my take on this thing. All right, so that's the bottom line. I mean, it's not very complicated. So and the Dow's calming down already. I mean, this is just craziness. People do not know how to read a Fed statement. That's the problem. Or to understand, it's because it's complicated, of course, but I mean, it's like you got to be able to understand, what's going on here. It's like, yeah, here's a statement, right? Down, then it goes up, but the reality is what Powell's saying. Powell is saying we are miles away from successfully controlling inflation. It's only we feel we've done enough. This is what they're saying, and it's bullshit too, by the way. It's, they know they haven't done enough, but they also, they almost destroyed the banks, and as I said, the Russell is negative. The small caps are getting killed by these rates are hurting everybody, and commercial real estate's about to collapse globally. So they would like to not raise rates, and so they're going to pause, and they're going to say, look, we're going to pause, but until inflation's under control, that's our top concern. Now. And again, macro picture, right? So I don't like to repeat myself. I feel like it's like people feel like I've said it all like before. It's like you keep saying the same thing. But on the other hand, there are people who haven't heard it yet, and it's important. So, it's a hard position for me to be in. But anyway, so conceptually, it's very important to understand that inflation is a cyclical thing. It's a push-pull. And what's the push-pull? The push-pull is first we had a pandemic. The pandemic crimped the supply chain. Okay, think about it. You got a pandemic, less people are showing up on the farm. So you don't have as many strawberries or whatever, right? And then there's less people who are working on the trains and less truckers and all this other shit, right? So all of a sudden it's hard to get things. But meanwhile, the government is handing out money. So people are still ordering things. They're ordering from Instacart, they're ordering from Amazon, so on and so forth. But globally, there's China shut down completely. You can't even leave your house in China. So how the hell is Amazon getting stuff? It's drawing out of the warehouse, okay? And you have a supply shortage. Not only that, but stuff isn't coming on the ships. So we end up with a supply shortage, but not a demand shortage, because the supply shortage usually accompanies the demand shortage in a recession, right? Supply goes down, demand goes down. But no, the government's throwing $3 trillion out every single year for 3 straight years. So what happens? So you have no demand shortage. People still want their stuff. And there's not as many people shipping stuff, but the demand for shipping goes up and the demand for cardboard boxes goes up, containers, blah, 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 FedEx. So all those prices start creeping up, because people are like saying, hey, I'm stuck at home and I want stuff. I need stuff. Send me my stuff. And people still go shopping, and people are still eating, and so on and so forth. So some things are shut down, some things are not shut down. And the end result, though, is as we go back to work and things go back to normal, we have depleted our demand, and we haven't gotten our supplies back to a normal pace yet. So the prices start creeping up for the things people want, and especially when you start, restarting your factory, and you absolutely need this many widgets to restart your factory, then the demand for the widgets exceeds supply, and prices go up. So inflation starts off with the demand supply shortage. The supply shortage drives prices higher. The higher prices become inflation. The inflation causes the workers to demand higher salaries. The higher salaries of the workers drives the second wave of inflation. Was that all clear? I hope so. So this is very, very important, though. This is the key to the whole thing. And that's why this morning I wanted to point this out, because this is hugely important. Where'd it go? That, there you go. CPI inflation in the 70s, okay? It's not a one-time thing, it's a cycle. And so we're in this trough part of the cycle, and this is like 2 full years that we troughed out in cycle. Inflation was still elevated compared to where it was, but it wasn't a panicky thing, but then boom, it starts coming back. Why does it start coming back? Because look how long it takes for the raises to come through. The actors were on strike for 6 months. The GM people, the auto workers were on strike for 3 months. And this is nothing. It's going to roll through the entire economy where workers they're not catching up. Prices aren't coming down. Therefore, the people who are struggling now to make ends meet will demand more money for their labor. They can't afford to work for what you're paying them. It's a very simple concept. So they will either demand more money from the job they have, or they will seek out a job that will pay them. And there are jobs that are paying more. That was that whole quit thing we had for a while, right? We had that whole quitting thing that set up, not the 70s, wait, where did this one start? 2013 to 2023. So if that's 2013, this is 2023. I guess we subtract 40 years, basically. No, not 43 years. So here's 2000. So that's 19. So this is 19, and this is today. So in 2019, 2020, we started having well, first of all, we were shut down, right? Inflation starts going up. Then it starts coming down a little bit as everything reopens, but it's not down permanently because we're nowhere near the end of the raise cycle. And again, that goes back to that chart of the US that I've shown many times, where I say, look, there's still 30 states, or no, there's 20 states that have $7.25 minimum wages. Obviously, that's not even livable. Until those states go over $10, you can't even pretend that we're anywhere close to fixing the labor rates. And that's going to be a couple of years. You know, California just put in that thing for fast food workers getting $20 an hour. You think it's just going to be California? And like I said, this is what that quit thing is about also. There's not a lot of mobility because it's very hard for people to move homes right now. That's a problem. But when the housing market comes down and people are able to move and find homes and apartments again, then a lot of people who you're paying $14 an hour in Tennessee or whatever, they're going to suddenly go, I'm going to go to California and make $20 an hour. You know, people move, people go where the jobs are, and that's freaking McDonald's. But then if McDonald's is paying $20 an hour, that means nobody in California can pay minimum wage anymore, right? Because all the fast food places are paying $20 an hour. We went right past 15 in California. We're up to 20. That means the person serving you fries at McDonald's is making $800 a week. Which, it's not really funny. I mean, that's what they should be making. That's what you need to live. If you can't make $40,000 working 40 hours a week, then what, how do you survive it? That's what it is. $20 an hour is $40,000 a year. So, we're now paying. You realize it's going to be nationwide, but it's going to be nationwide in a couple of years. And when every fast food worker is making $40,000 a year, and when basically minimum wage jobs are $40,000 a year, then your job's going to be $100,000 a year. And guess what? More inflation. But then it's that corporate bullshit that you hear in the news, especially on Fox Media and things like that, where you're being told, oh, that's going to destroy society. It's like, no, it's not. Because when you do the math, let's do the math because this is important. So I'm going to close out with this. We'll do the math. Oh, okay. Let's see. Well, Warren's not going to be good at doing the math, but let's ask him. Let's see if Warren can do the math. I wonder if I can talk to him. Does my mic work? No. Oh, well, it's being used for this thing. That's why. Okay. Please do the math on CA McDonald's raising wages to $20 an hour for their workers. What will they have to raise food prices to break even on the increase? See, this is why he likes Wolfram, because then he can do this stuff for me. He can do an analysis. Usually I would ask Bing, but he should be able to figure this out. Oh, tough question. You might break. So I copy the question. I open up Bing. And we're in chat. Don't want Copilot. How do you make this go away? Click to use your voice. Not right now. Boy, how do you get rid of this screen? Chipotle Express raised prices mid to high single digit percent. See, that's nothing though. I cannot find any information on how much they would have to raise prices. Okay. Did he explode? Ian says, what plugins do I use for ChatGPT? I'm currently using WebPilot and Wolfram, and that's Warren's request. I asked him what plugins he wants, and he wanted Wolfram. That was so he really likes doing calculations, but this seems to have exploded him or something. Let's see how we're doing here. Oh, there we go. Oh, he's still using it. Wow. Wow, dude. I feel bad. You sent him on like some kind of thing. And WebPilot that. And I started experimenting with some market analysis things, something called Boo something. You'll find it if you just put in Boo in the plugins. I wonder if this tells me. Let me see if it clicked right. No, it doesn't really. Shit, it'd be nice if it did that. Anyway, so I know he uses Wolfram. It's WebPilot because the Bing search on him is not working well. Although they say that they are about to give him the ability to use all the plugins anytime he needs them, which I very much don't see how that's going to work because look how stuck he is just using Wolfram right now. But he loves Wolfram. Every time I take it away, he gets upset. So like it's his favorite toy. But yeah, so it's that. So generally I'm using Wolfram, WebPilot for looking up for using the internet. Bing tends to crash him all the time. When he uses Bing, he just constantly runs out of the thing, and that it runs out of tokens. Let's use the proper term. So he runs out of tokens. Bing doesn't run out of tokens because Microsoft doesn't care how much money it costs to do a web search. But obviously ChatGPT has a budget. So they can't just let it go and be whatever it is. Microsoft Microsoft doesn't care if they lose $1 billion doing search this year. See, that's the difference. So for Microsoft, as long as they're gaining market share, as long as people are using Bing, for them, if that costs $1 billion in allocations for the search, that's no big deal. Not only that, they're buying it from themselves. They've got their own, it's enhancing their Azure platform, because that's where all the searches are going through. So that's why with Bing, you can do these massively complicated calculations. There's no upper limit to how many tokens they're going to allow Bing to use. They do limit the input query, and they limit the input query because, frankly, the way Bing works, whatever I'm doing now to poor Warren, it's obviously blown his mind, and Bing came back with a half an answer. But it is a useful answer. In other words, what he's basically saying is that, well, the actual thing that's happening is that they're telling you that they're doing a high single digit, which is 10%, let's say, of an increase. So the question is, if you're getting a raise from, let's say $14 an hour to $20 an hour, because California is just under 15. So if you're going to raise from 14 to 20, that's a 33% raise. Then the consumable items that you buy go up 10%, you're 25% ahead of the game. And then from the standpoint of people like us who make, let's say make $100,000 a year, something like that. So now you're going to make, instead of 100, you're going to make $200,000 a year, but a hamburger costs 50 cents more. You don't care. And this is why it's bullshit when you hear on these people on the media talking like, oh, woe is the consumer. Oh, these wages are going to be terrible for society. No, they're not. We all get raises. Everybody gets raises, and we all catch up with inflation. And if you can stop inflation from getting out of control while people catch up in wages, that's when everything goes back to normal. That's the problem with the Fed, is the Fed doesn't want wage inflation, because they're not really looking out for what's good for the people. They are looking out for what's good for the banks and the corporations, and they don't want wage inflation. They don't mind price inflation, they mind wage inflation. That's got to be stopped. But it can't be stopped, because there's a reality to the situation in which people will not work. And eventually, by the way, if the corporations refuse to give people raises, what's going to happen? People will not work for corporations. They'll work for themselves. They'll say, well, I could do this. I don't need to work for Arthur Andersen. I can go be an accountant. Right? I can go do freelance accounting. I can go to a company, because everybody works for a corporation. I mean, frankly, anybody who works in any job, unless your employer is not very smart, is producing more than they're getting paid for. And it's just a question of whether or not you can market yourself. When times get tough, believe me, people put the time in to market themselves. And that creates a labor shortage, and that creates competition and a labor shortage. So eventually, the corporations wise up and allow an equilibrium of salary. They'll have to give up some of their insane profits that they've been taking away from the workers for all these years. It's viva la revolution. That's what happens. But that's why you have that trough, which we were talking about before. That's why you're going to see that trough, and then you're going to see an increase. Oh my God, seriously? All right, we'll never find out what Warren has to say about this, because I broke him. That's why you have this. Eventually, the wages start coming in. You might get your supply chain under control. You might get your costs under control, but the wages are going to get you in the end, and you're going to have a huge bout of inflation. Then you've got to raise prices again, and eventually you hit a point of equilibrium and things calm down. But they never go negative. This is inflation, right? Inflation goes up and up and up, and then it just goes up less. But it's always there. This isn't negative, this is going up less, because you hit an equilibrium point and everything calms down, and then regular increases go from there. But we're at disequilibrium now, and it's not going to be all magically fixed. All right. So thanks everybody for coming. I have got to run, and it's been fun, and we will do it again next week. All right. Take care, everybody.